Are you a high net worth individual? Are you planning to retire one day? You probably already know you're going to have to pay some taxes on that retirement money. But do you know how much? In this video today, I'm going to break down why so many high net worth people pay way more in taxes than they ever thought they were going to pay. Let's talk about taxes. What do we do here at DTaxMe? We reduce your taxes through investment strategies. I know that sounds a little bit bizarre, but hang in there. I'm going to explain it all in minute detail. Why is this important to millionaires and multimillionaires? Well, the fact is that taxes are going to be your number one expense in retirement and also for your estate. But most multimillionaires have never looked at reducing those. They don't even look at taxes as a reducible expense. And that's what we're going to help you do. Any good endeavor starts with a plan. Just think about a great one like going on vacation. You start with a plan, you build a dream. Are you going to go on a cruise? Are you going to drive across Alaska? Are you going to go on a bike trip? There's a destination. You have an image in mind of what you want to achieve. So does tax reduction strategies. In fact, if you don't have a plan, you're going to fail here. That old adage is very true. So we're going to help you put together a plan. It's like a flight plan. It's very dynamic. My office in Buffalo, New York sits right on the final approach for Buffalo International Airport, and those planes are always correcting back to course. In fact, when they take off, immediately there's probably some kind of crosswind, tailwind, headwind that they have to affect for, or they're going to be off course many miles down the line. Your tax strategies are exactly the same. They have to be done with the destination in mind, which is the strategic part of the plan, but also tactically as you go. We use a tactical timeline of course, the year, because that's how taxes are due on an annual basis. Just understanding this gives you an edge up. So I've always found that telling stories helps people really understand what they're going through. I'm ex-Air Force, so I use a lot of airplane stories. My office is in Buffalo, New York, and it sits right on the final approach to Buffalo International Airport. So that's why I wanted to use an analogy of an aircraft and an aircraft going on a trip. It'll help you understand why we need to make adjustments along the way with our final destination in mind. All right, our hypothetical example today is John and Mary. It's a pretty simple example. John is a government worker. He has a pension, and of course, he's got W-2 income. He's a wage earner. Mary is a business owner. Note, in this example, I did not include the business as an asset. That's really important. But if I did, it would only make this example even more impactful. Very simple portfolio. We did like a 60-30-10 or a 60-40, so just a balanced portfolio. They earn about $10,500 a month. They're both going to claim Social Security. And of course, John, because he works for the government, will have a pension to claim. We did a very simple, moderate allocation, modified balanced approach, like a 60-30-10 or a 60-40 for the investment growth. Assets, again, I did a very simple example. They have about $3 million in invested assets. They have a home at about $375,000. Nothing too complicated. Assets split, fairly balanced between them, mostly in deferred accounts, which you're going to find is problematic going forward. And it's much like most Americans who have been taught to store money in their deferred accounts. For most people, it's fine. For high net worth earners, it's a big issue, as you're going to see. It becomes a snowball later in life that carries a high tax liability. Their income, their cash inflows are about $350,000, and they only burn about $110,000, $120,000 of that a year for their expenses, which helps them accumulate over time. Like many of the clients I've worked for, they sacrifice, they save. This is what has made them successful. The issue with that is what has made you successful soon becomes the enemy. As with most of my clients now, I'm advanced in my career and successful. I deal with successful clients. Their probability for success is not an issue. They are going to enjoy their retirement. It is going to be secure. That's not the question. The question is, how much are they going to pay the government in taxes? The answer might surprise you. The first thing that we're going to do is map out your investments with an investment growth projection projection. This is the only way to analyze what your taxes are going to be in the future. This is the strategic outline, the flight plan, if you will. Once you know where you're going, you can see what's going to happen. How much do these assets grow to, and what are the implications of them? That's the strategic. Then we break it down on a tactical basis. So as an example, if you wanted to reduce your taxes and you were going to use a tool like a Roth conversion to do that, we would implement that tactically on an annual basis. How do we do that? We're going to work in conjunction with your team, which would include your CPA and your legal team, to make sure that everything is dovetailed together on a tactical basis. It depends. Generally, we do it at the end of the year after Thanksgiving because most of your income is realized at that point. Most of your decisions have been made. We'll get the team together on a phone, Zoom call. We'll talk about what the moving parts are and what needs to be adjusted, and then we have time to implement that tactical strategy to align it with that strategic course. Now remember what the goal is. The goal is not necessarily to reduce taxes. Jay, what are you talking about? The idea is to reduce your lifetime tax liability. What I find is the reduction in taxes annually might actually work counter to the strategic plan. I'm going to do the reveal on this right now. Most Americans have been taught and promoted to store their money in their deferred accounts. What kind of account is that? That's one that you don't pay tax on. And in fact, in the year that you take it, your income is reduced by that amount. It's a benefit. Over time, here's what happens, and it's what happened to John and Mary, is those assets build up. But so did the tax liability. With John and Mary, they have about $2.8 million saved up in their deferred accounts and just a small amount saved up in their non-deferred accounts. They have zero saved up in tax-free. And as I reveal this, you'll see how problematic this is. Again, I want to reiterate and reassure that what made you successful before now becomes counter successful and is going to hurt you in the future. And somebody needs to talk to you about that to help you unravel that. Famous CPA Ed Slott calls this the tax time bomb. Why does he use that reference? Because most people, and certainly most high net worth people, don't know what's coming, and they need somebody to share that information with them so they can make a correction. In the illustration, you'll see the tax brackets for 2022. These tax brackets are going to change as the Trump tax cuts are going to go away, but that's not important. What's important with this graphic is that taxes go up as you make more income. It's graduated. The higher your income, the higher percentage that they take you. What people don't realize is this is done on an annual basis. So each year you have this tax gate to go through, and most people don't have a strategic plan to look at these gates and take advantage of them. You probably can already catch my inference. This is not an asset game. This is a cash flow game. And if you don't have good control and strategic vision for your cash flow, the government's going to take your money. Cash flow has to do with when the money comes out over time. Changing when you take money could have a drastic impact on your total net worth in the end. In this example, changing when you take your Social Security could impact your net worth over $1.3 million. Just think about that. The information just saved you $1.3 million. That's the impact of proper cash flow and tax planning. When I make this point, a lot of people say, yeah, but I don't want to die without taking my Social Security. And I often reply, how long did you think you were going to live? The crossover on Social Security is generally out about 7 or 8 years. Generally, I ask people, how long do you think you're going to live? Do you think you're going to live to be 75? So somebody retiring at 62, they can see that they're going to live to 75 in their mind. It makes sense to them. Yes, I'll take the Social Security later and gather in more income from that source. In this graph, and this is one of the tools that we use, we can show you where that crossover is so you can visualize it. That's another important thing with the work that I do. I'm really good at helping people visualize what is going on. Words don't do this science justice. I don't think words will help you understand this. I really think that you need images and visuals. graphs to illustrate what is going to happen to you down the line. Without these tools, I think you'll probably make the same mistakes that many high net worth Americans have made. The problem you and John and Mary didn't know about: the tax time bomb. All right, in this example that you can see in the graphic, John and Mary are just clipping along. Remember, they're spending about 110, with inflation, 130, 140 as time goes on. And then, boom, $347,000 in forced distribution that they don't want and they don't need. Now, no big deal, you might say. We'll just take the money. The problem is that money comes with a lot of taxes. Their taxes go from about $23,000, $24,000 up to $130,000 because of that forced distribution. Think of the drastic change that just happened in their tax life. I had a prospect come in. He was interviewing me. He worked for a Lutheran organization in our area. He was not really a pastor, he was an administrator, and so was his wife. They had very high incomes, and they were also going to have high pensions. So they had high Social Securities because of the high incomes. They had high pensions. And I grew up a Lutheran, so I can say things about Lutherans. They're also penny pinchers. Most Lutherans can tell you how much change they have in their pocket. And I was talking with this gentleman, and we were talking, and they had these huge deferred comps. And I just did the math in my head. And I said, did you realize that when you hit your RMD age, you're going to have an additional $60,000 of taxes to pay because of the forced income? And he went flush. It was visceral. I could see the blood go to his head, and he said, what are you talking about? And he said, you didn't do any math or anything. I said, no, I did it in my head. I've been doing this for so long. I just did the math in my head. But hey, I have a financial calculator right here. Let me get it out and I'll get you more accurate numbers. And I went over it. You and your wife have this much in your deferred comp. You have this much in the 4 income streams coming in, and boom, here's what your tax bill is going to be. And he said to me, how come nobody else has ever told me that? And I said, that's why you're here. Let me help you. Now let's revisit those tax brackets, because now I think you can start to see somebody that has a very high probability of retirement success. They have security, but they've saved their money in the wrong places, and now they're going down this flight plan where taxes are going to be forced on them. Remember, the taxes are going to be forced on an annual basis as we go through these gates. So I revisit these tax brackets so you can understand when that income jumps because of the forced RMD, it's going to force you progressively into new tax brackets with a higher percentage of taxation. Let's recap. John and Mary sacrificed and worked hard all their life. They saved. They built a family, and they continued to save. The kids left. They saved even more. They plowed that money into their deferred plans. Good for John and Mary, but it's creating a situation you can see. The probability of a secure retirement is not in question. What's in question is, as this massive amount of money moves down this timeline, how much of it is going to be taxed. And they've set themselves up for a precarious situation because the RMD forces that money out on an annual basis. I keep coming back to this. You have to understand the effects as we go through these annual gates. I bring up this graphic again of the tax brackets because when that RMD jumps, it forces the income and the tax bracket up, and that's why the tax ramifications are so adverse. The solution that you don't know about, and probably nobody else has ever told you, and this is what I find in my practice, these high net worth earners come in, and about 20 minutes in, I blow their mind. Poof. Because nobody's ever told them, they're continuing to add to the problem of plowing money into their deferred plans. The graphic that you see here is what I call the golf cup. Now, I don't golf, but a lot of the guys and gals in my office golf. And when you're on the putting green, you cannot hit that ball too hard. It'll go blowing right on by the hole. This is the exact same thing you have to use with your tax plan. We need a little bit of finesse here. We need to drop this tax plan in the cup on an annual basis, just like you do over 18 holes of golf. What does that mean? Well, you can see the high income they had when they were income earners because they don't spend a lot, about $110,000 a year adjusted for inflation. That income drops in retirement because they don't need so much. And then when they take their RMDs, or the RMDs are forced on them at 72, boom, the income goes back up. And there's that golf cup that you need to take advantage of. And that's why you can't wait. And many people put off retirement planning and taxation planning over and over again. It's urgent that you start right now. All right, in this graphic, and this is one of the great things that I can do for you to help you visualize, I paint out where those taxes are coming from in these color sets. So you can see what the federal, what the state, what the FICA taxes are, and therefore we can plan. Just like golf, if you hit the ball too hard, you're gonna overshoot the hole and it's gonna cost you a stroke. It's the same way with taxes. If you don't make changes and start paying taxes earlier, I know that sounds strange. You've been deferring all your life and it's helped make you successful, but now that all changes because in the distribution phase, what worked in the accumulation phase now becomes the enemy. I want to remind you, our goal is not to save you taxes per annum. Our goal is to save you taxes over your lifetime. The first graphic showed you the impact of when you took your Social Security. A delay gave you over $1 million of impact on your net worth. It's called sequencing. I want to reveal some more sequencing events for you next on this next graphic. The baseline that we use to evaluate all the strategies is called a pro rata distribution. What pro rata means is equally diminishing all the different accounts over time. That's our base. That's how we evaluate what we should do in the future. To evaluate every plan, you need a baseline, your reference point to evaluate other ideas. In our situation, we use a pro rata distribution, which means you equally tap from all your different strategies. This will become the baseline to evaluate what my suggestions to you might be. Here is an extreme example of a bad distribution strategy. In this case, John and Mary used the worst sequence. What does that mean? It cost them $3.8 million. $3.8 million. Why? Lack of knowledge. A better distribution strategy for John and Mary would be to withdraw from their taxable account, then their tax-deferred account, and then their tax-free account. That strategy puts $4.1 more million in their pocket. Again, just because they know what to do. You can see on the graphic the different tax brackets. This really allows us to do some intricate planning for you and have a conversation about what strategies you want to do. RMDs right now are at age 72, and I start talking about this with groups and they say, yes, but good news, they're going to move RMDs. Congress is looking at moving RMDs to 75. Isn't that great? And I say, no, it's terrible. It only amplifies the problem because the deferral is the problem. So the fact that they're going to extend this will only make the amount of your taxation higher. All right, here we are. We've done a great job over life. We used our driver and got it down the fairway. Then we used our chipper and we got it on the green. Now we need some finesse. What are we going to do? In this example, what we did was we used that income gap, that time period between when they retired and the RMD, to do Roth conversions, and we filled up those income brackets. And I'll work with you on this. Some people want to do a lot, some people want to do a little. We come up with a strategic plan, like you want to convert $1 million over the next 5 years, and then we plan that tactically on an annual basis. When we sit down, we usually sit down more than annually, but when we sit down to have this tax meeting, I will put this cash flow in the illustration so you can see what the ramifications are going to be. We can talk about that, and then we can also confer with your CPA to make sure that we're good to go on that income. In this example for John and Mary, what was the result? What was the result of the knowledge with sitting down with me? $8 million better net worth for them. Doesn't that make sense? Let's do a review. For the affluent, taxes are highly likely to be your biggest expense over your lifetime, and a lot. How could you change that? Education, and then some action. You're gonna pay the taxes anyway. You're going to file the tax return anyway. Has this ROI, this 20 minutes or so, been worth it to you? If I could show you a way to save 2, 3, 4, in this case, $8 million, would it be worth it? To sum up, if you haven't realized it already, you've saved all this money over time. You've done what you've been told. You've put it in your deferred accounts, your IRAs, your 401ks, your deferred comps, and now what you're realizing is Uncle Sam is going to take you to the woodshed if you don't know how to plan for this. I'm not trying to scare you, I'm trying to educate you. The reality is so many people don't have this information, and it breaks my heart as they go into retirement and give up so much of their hard-earned work to the government unnecessarily because of lack of knowledge. I'm on a mission to help hardworking Americans that have sacrificed and saved their entire life to keep what is justly theirs. The only barrier between them and keeping their own money is the information, the rules, and the regulation. Let me help you unwind that. Book a call at the link below. I look forward to speaking with you soon. The sooner that you address this, the less taxes you will pay. That same miracle of compound interest is working in your tax deferred accounts against you. The longer you leave this issue unaddressed, the more taxes you're going to pay. The tax year is ticking by, and so is your overall strategic tax timeline. Book a call now. The sooner this is addressed, the more money you'll probably save. I will be speaking with you directly. You will not be speaking with a member of my team. We will have a personal conversation about your situation to try and help you. After doing this for 20 years and helping hundreds of people with their finances, there has been no time in my life that I feel more passionate about the impact that I can have on your life with this very information that I shared with you today. Book a call, and I look forward to speaking with you very soon.